Hello and welcome to Geojit Spotlight. As we look ahead to 2026, the Indian economy is entering an exciting phase of growth and recovery. From a possible drop in interest rates to a big boost in rural spending, several factors are coming together to create new opportunities for investors. But with so many changes happening, which sectors should you actually focus on? Today, we are breaking down the 2026 outlook for 7 key sectors, ranging from banking and IT to healthcare and real estate. We will look at where the growth is coming from and where the valuations looks most attractive. Let's dive straight into the details. First, banking and NBFC. The sector is expected to sustain double-digit growth, supported by MPC's policy and enhancing loan affordability. Large-cap private banks now appear attractive as their valuations remain below the 5-year average. Meanwhile, mid and small-cap private banks are actively raising funds to growth and scale operations, offering compelling opportunities for strategic investors given their favorable valuations. Nifty Bank's blended forward price to book is around 1.97x, which is below the 5-year average of 2.06x, indicating attractive valuations. Next, consumer discretionary. India's net disposable income grew by a healthy 10.3% CAGR over 2020 and 25, supported by GDP growth, policy and macro tailwinds, easing inflation, tax reforms to strengthen household spending. Rural wage growth remains strong at 20.9% in October 2025, while urban wages are expected to rise with corporate earnings, 8th pay commission, credit taxes, and low interest rates. Auto sector growth driven by affordable financing, new launches, and tax rationalization. Domestic sales growth expected to sustain despite a high base. Valuations, when we see the valuations of consumer discretionary index trades at 32x on 1-year forward basis, below its 5-year average, indicating better risk reward. Next is FMCG. The FMCG sector is poised for a steady recovery, led by continued rural demand, given a favorable monsoon, improved farm income, and government support through MSP and rural schemes. Urban consumption is expected to strengthen on higher disposable incomes, aided by tax cuts, benign inflation, and upcoming 8th pay commission. Softening commodity prices are easing input cost pressures, enabling margin recovery after 2 years of strain. This sector trades at a 1-year forward PE of 34x, moderately below the long-term average. Overall outlook remained positive with strong structural drivers. Global commodity volatility and intensifying competition from regional brands remain key risks. Healthcare. As per CRISIL report, the Indian healthcare delivery industry is projected to grow at a CAGR of 12% between FY24 and FY28. Growth will be underpinned by structural drivers such as aging population, rising lifestyle diseases, and great healthcare awareness. Hospital companies under our coverage as poised for strong results, supported by new capacity and higher utilization. Hospital sector valuation stands at 25.6x on a 1-year forward EV by EBITDA, which is around +1 standard deviation level. We expect this premium valuation to sustain given ongoing capacity additions and a robust 25% top line growth over the next 2 years. Domestic pharma companies are poised for strong growth over the next 2 years, driven by strategic acquisitions that expand market reach and bolster product portfolios. Infrastructure. IAP growth is expected to accelerate at 4.2% in FY27, above the 10-year average of 3.3%. With manufacturing expected to grow at 4.1% and the electricity sector expected to grow at 6.5%. In H1 of FY26, MORTH and railways utilized 63% and 57% of their capital budgets, well above the national average, signaling stronger execution in H2. Infra index trades at a 1-year forward PE of 14x, marginally above the long-term average. Overall outlook remains positive with an expectation of a healthy order book CAGR of 20% over FY25, FY28. Information technology. Indian IT services are set to recover in FY27, supported by easing macro concerns, INR depreciation, and stronger traction in AI-led deal activity. Companies are driving margin gains through structural headcount optimization and near-peak utilization, supporting a 8% net income CAGR over FY25-27. Near-term softness in discretionary spending and deal ramps persist, but prospective Fed cuts could revive demand and low valuation offer long-term upside. The sector is currently trading at a PE of 24x on a 1-year forward basis, which is 8% discount to its 5-year historical average. And finally, reality. The RBI's recent rate cut is expected to improve affordability and lower borrowing costs, which will strengthen this sector. India's data center market is on a rapid growth trajectory, with capacity expanding due to strong demand, cloud adoption, and digital transformation. The sector's outlook remains positive. However, we remain in a selective approach, prioritizing companies that offer both attractive valuation and sustainable growth. Valuation remain reasonable with a price-to-book ratio near to its 5-year average of 3.71x. The real estate sector has been in a consolidation phase for the past 1 year, marked by softer residential sales along with muted launches and stable inventory levels. Rising urbanization levels coupled with the sustained demand in luxury and ultra-luxury segments are expected to keep inventory levels low and drive long-term growth in Tier 1 and emerging Tier 2 cities. The key takeaway for 2026 is to remain selective. Focus on quality companies with strong order books and sustainable growth. If you found this sectoral breakdown helpful, please hit the like button and subscribe to Geojit Spotlight for more expert market insights. Wish you a happy new year.